हेलो फ्रेंड्स, गुड इवनिंग टू ऑल ऑफ यू। एंड आज हम स्टार्ट करने वाले हैं 8th सेशन रिलेटेड टू बीएफएम, दैट इज बैंक फाइनेंशियल मैनेजमेंट। तो आज मॉर्निंग में क्लास नहीं हुई थी, दैट्स व्हाई वी आर गोइंग टू कवर द सेशन ओवर हियर। एंड इन दिस वीडियो वी आर गोइंग टू कवर वेरी इंपॉर्टेंट चैप्टर, द लास्ट चैप्टर फ्रॉम द मॉड्यूल बी of BFM, that is the liquidity risk management. Now the bank is to manage the liquidity, the bank is to manage the assets and the liability, so that's why we also say it to be the asset liability management. You have to basically manage the cash inflows and outflows, and definitely you must be having the liquidity over the different time horizons. So we will be learning each and every concept related to same. And if you want to get the PDFs of all the particular videos, and if you want to get 130 plus case studies for BRBL and ABFM, you must be WhatsApping right now, writing CAIIB group, and we will be make sure that you join our group particularly, and you'll be getting each and everything over there. So kindly do mention CAIIB group and do join this particular group over there. And in between, do verify the audio video quality so that we can proceed. And further, if you're watching me for the first time, I'm Ashish and I bring daily sessions related to JAIIB, CAIIB bank promotions and the certification exams for the JAIIB, IIBF candidates, CAIIB, IBF candidates, and much more. And I am trying actually so that to make these concepts very much easier for you. So kindly do confirm at the earliest the audio quality so that we can proceed, and we will be learning amazing concepts in this particular video. Kindly do the needful so that we can proceed. And further, the crash course, as I told you, for the CIIB is now available. You can be learning the basics of each and everything from that particular thing. If you have not even prepared or started preparing for the CIIB right now, you can still be clearing the CIIB exam in the very first attempt. For that particular purpose, do join our crash course. You just simply need to write CIIB crash course and further WhatsApp it to the following number, and you'll be able to join the crash course too. So audio video quality seems to be working very fine. So let's start the session over here. So particularly, first of all, we are going to learn about the liquidity risk management, that is LRM, we can say, that is liquidity risk management, that what it is actually, right? So we basically want to be solvent. We basically want to be solvent, that we are not bankrupt and we are having enough sufficient liquid resources with us. Okay, so it is very much important for the bank to be liquid. If the bank is to maintain the liquidity, and further the bank want to be solvent, right? And for also the bank is to make sure that the bank is having adequate level of the resources so as to maintain and so as to fulfill the short term obligation as well as the long term obligation. Now obligation is basically like, let's say case the bank is having some assets. So if you're talking about the bank over here, let's say XYZ bank is over here, and the bank is to maintain the assets over there. Now asset is actually related to the amount the bank has particularly lent. The amount has particularly lent. Now when a asset is actually formed, when a actual asset is formed, there is outflow of the cash, there is cash outflow. But when there is a maturing asset, when it is actually related to the maturing asset, in that particular scenario there will be inflow or outflow. Kindly do answer at the earliest. In case of the maturing asset, there will be inflow or outflow. Kindly do answer at the earliest. So the maturing asset is actually that one in what particularly the asset is going to mature. Let's say it was having a tenure of 5 years. Now the 5-year tenure is ending. So it will be a maturing asset over there. And in case of maturing asset, there is cash inflow. There is cash inflow. So in that scenario, it will be the cash inflow. You must be understanding this particular concept. It is very much important that why mismatch of the funds is there, right? You must be understanding the same. Now this is very much important to understand. And also in the case of, let's say, if we talk about the liabilities, when the bank is actually accepting the deposits from the depositors, it is accepting the deposits from the depositors. Or let's say the case that the bank has made the borrowings from the different institutions. The bank has made the borrowings from the different institutions. In that scenario, it is forming what? It is forming a liability for the bank. It is forming a liability for the bank. In case of liability, in general liability, if the liabilities are increasing, there will be cash inflow or outflow. Do answer here at the earliest. So if there is increase in the liabilities, in that particular scenario, there will be particularly cash inflow or cash outflow. Let's say case I have basically received a deposit amounting rupees 10 crore from one of our depositors. Definitely there will be cash inflow. So in that scenario, there is cash inflow. But in the opposite scenario, when we are talking about the maturing liabilities, when we're talking about the new term, not new term, but you must be considering it as a new term because we have not covered it before, right? So maturing liabilities we are talking about. When a mature liability is maturing, let's say FDR was having a maturity after 3 years and now it's maturing. In that particular scenario, there will be cash inflow or outflow. In that scenario, there will be cash outflow. There will be cash outflow. So as simple as that. Is that clear? Right now, there may be the difference between the cash inflows and outflows. Now understand this from the time horizon point of view. Let's basically draw a timeline over here. Okay, and we are considering it for the different periods 0, 1 and 2 and let's say 15 and 28 and so on, right? Now in that scenario, let's talk about the day 1 over there, the very next day. Let's say the case on this particular scenario that the maturing liabilities are amounting 300k. These are maturing liabilities, right? And further, the maturing assets are amounting 200k. In this particular scenario, the gap will be positive or negative. Kindly do answer at the earliest. Kindly please look into the thing. I've already explained to you the concept to you related to the maturing assets and liabilities. Now do let me know at the earliest it will be the case of a negative particular side over there or the positive side over there. So the gap will be positive in this case or negative in this particular scenario. Kindly do answer at the earliest. So it is actually related to what kind of gap? Let's have a look at it. Let's just have a look at it. So we are having the maturing liabilities. Liabilities means the deposits we were having before. Now those are maturing. So it's actually outflow. It is outflow, right? And maturing assets means this particular amount we will be receiving in just one day. We will be receiving 200k and we are to pay 300k. That is, we are to pay more, right? So this is the concept. We are to pay 300k, that is 3 lakh rupees, and we will be receiving only 200k. So particularly we are short, we are having the shortage of funds. We are having the shortage of funds. That is what? That is, it is a negative gap. It is a negative gap and it's a risk in between itself. It's a risk associated with the same. Why so risk? Because it may be the case that the bank is not able to procure the difference between the same at a very reasonable cost. Let's take the case the previous liabilities, that is a deposit, was available at 7%. But now it may be the case that the deposit the bank is not able to avail at 9% also, right? That may be the case. So for that particular purpose, the net interest income will decrease and ultimately it's going to impact the bank's earnings. That is why it is said to be a risk. Is that clear? So that is a liquidity risk that we need to manage. That is a liquidity risk that we need to manage. I hope that you must have understood the concept so far. Kindly please do mention yes, and further if you have been liking the video, you are basically able to learn the concept from this particular video, do give this video a thumbs up and kindly do share this video among your friends and colleagues. And you can also be sharing this video in your WhatsApp status. It will be just taking a while for you, but it will be very much helpful for me. Thank you so much for the same in advance, right? So now let's move further toward the key consideration related to the liquidity risk management. We are talking about the liquidity risk management. I'm just writing the shorthand over there. That's the LRM over there. And we are talking about the key consideration, that why it should be considered good so as to for the liquidity risk management. First thing it's related to, we must be having the availability related to the liquidity assets. So liquidity assets must be available with the bank so that the bank can pay off the short-term obligation as well as the medium-term obligation as well as the long-term obligation, right? And further, it is also good to look at the volatility of the deposits, that the deposits which are available to you, whether those are term deposits or those are core deposits or those are volatile deposits over there. We should be considering the volatility of the particular deposits over there. And also we should be looking at the degree of resilience, that what is the degree of reliance, how we can be relying on the same, can we be relying on such set of particular deposits over there, yes or no? We should be considering the same. We should be also be looking for the diversification. We should not be depending upon just one set of the particular deposits over there. We must be having the diversification. Like let's say you're having the liquid assets with you, but there are different kind of liquid assets. You can be going for the money market instruments, you can be going for the gold particular assets over there, gold holding over there. You can also be going for the cash holdings over there, right? So different things must be considered so that the concentration risk can be reduced. And further, we should be looking for the historical trends. We should also be looking for the historical trends, that in the previous time when the particular same kind of things were there, what was the need of liquidity. So we must be exploring the historical trends also, right? We should also be maintaining the liquidity risk management for the purpose of maintaining our market reputation, right? For that is also required over there. And further, we should also be considering the impact of off balance sheet exposure. It may be the case that you are having the contingent liabilities, it may be the case that you're having the off balance sheet exposures. You must be consider the same, and as per it, according to the dat, you should be maintaining the appropriate liquidity with the bank over there, right? So that's the scenario related to. And for the that is a actual liquid consideration, we can say. So key considerations related to the liquidity risk management over there, right? Is that clear? Now, what could be the different factors? Now, what could be the different factors? And we say these factors to be as the drivers. These are also as the drivers. Now, there can be two ways that the liquidity of a particular bank is impacted. It could be related to the internal factors. It could be related to the internal factors, and it could also be related to the external factors. First of all, we are going to cover the internal factors. We are going to cover the internal factors, that how it is affected over there. So if you're relying heavily on the, if the bank is actually heavily relying on short-term funds, that is definitely going to impact, right? Because let's say I'm just having the short-term funds, that is a volatile part that I'm having right now, and it may be the case that I may have sanctioned the long-term loans over there, so it may basically get impacted. It's an internal reason. Other, it could be related to, we have just read about it, it's actually related to the negative gap. When your outflows are more, that is a liability side is more, maturing liability is more than the maturing assets over there, so that is also going to impact your business, right? And further, the third factor, it's related to off balance sheet exposures. When you're having high leverage, you have created a very high amount of off balance sheet exposures, that is also going to impact the liquidity over there, right? So that's the third factor over there. And fourth one, it's related to the concentration, the short term deposits. If I have very heavy particular dependence upon the short-term deposits over there, that is also going to be impact the liquidity. And further, it may be the case that you're having the lesser liquid assets with you, that is a illiquid asset. It may also be the case that you're having the lesser liquid assets with you, and in that particular scenario you won't be able to liquidate those particular assets, and ultimately the liquidity will be impacted, right? And further, it may be the case that you have lower longer term funds. It may also be the case, the last one, lower longer term funds, it may also impact. Is that clear? Okay. Now, let's just have a look at the thing, that what are the external factors. Now, so far we have read about the internal factors. Now, let's learn about the external factors, right? So, it may be the case that the market is very sensitive. Market is very sensitive. That basically happened in the case of the Yes Bank case, right? Now everyone was basically afraid that our deposits, we may be losing, and the person started basically withdrawing the amount from the banks over there, right? And further, it could be related to the market shocks. It may be the internal market shocks or external market shocks, right? These shocks actually do impact a lot. Like people in those particular hard times do require liquidity. They are having lesser faith in the banking system, right? Or it may also be the case related to slow economic performance. The economy is not working fine, right? So that the interest rates may reduce, and ultimately it's going to impact the businesses. And for the people, if you are not receiving appropriate interest on your deposit, let's say the bank start giving just 4% on the FDR, why would you be keeping it in the form of FDR in the bank over there? You'll be investing it somewhere else, right? And ultimately the the deposits will fall in the bank over there, right? So that's a very huge factor, right? And further, as I told you, lesser faith in the banking system. If the depositors are having no faith or lesser faith, definitely they won't be having any kind of deposits in the banks over there. And also related to unplanned termination of government deposits. Let's say the government actually withdraw the scheme and further the deposits were terminated. Now that may also be the case that the people won't be having the funds in the banks anymore, right? So these are the external factors and these are the internal factors related to the drivers, we can say, which may drive the liquidity risk in the banks over there. Okay, now let's learn about the types of liquidity risk. Let's simply now learn about the types of the liquidity risk. So there are different types of liquidity risk over there, and further there is actually two types of liquidity risk. One, it is actually related to what? It is related to funding liquidity risk. It is a funding liquidity risk. So it's a case when the bank is not able to maintain the obligations. The bank is not able to meet the obligations, right? That is particularly related to, like I told you, that there was unexpected outflow of the funds. Now in that scenario, the bank is not able to fulfill the obligations over there. That will be the bank is not having the liquidity with it. Bank is not having the liquidity with it. So that will be the case related to what? That the bank is having the funding issues or the funding risk over there. That is said to be what? That is said to be the funding liquidity risk. And the second type over here, the second type, it's actually related to market liquidity risk. It's a market liquidity risk. Now, what do you mean by market liquidity risk? Let's say the case that you are having an asset and you can be selling it in the market at the price of rupees 100, right? That's a fair value of the asset that you can be selling the price at particularly, but you're not able to conclude that transaction because there is no liquidity in the market at all, or there is illiquidity market at all, or there is inadequate market depth over there and market disruption is there. So that will be related to what? That will be related to the market liquidity risk. Okay. Now, as per the BCBS supervision of the liquidity risk, there are how many principles? This question is for you. Kindly do answer at the earliest. As per the Basel Committee on Banking Supervision, supervisory review process over there, if you're talking about supervision, how many principles are there? How many principles are there? We won't be considering the principles over there. You just need to let me know the number of principles we are having, number of principles we deal with in this particular scenario. Kindly do answer. There are how many principles? There are 13 principles. There are 13 principles for the same. Okay. Now let's learn about the governance of the liquidity risk management. Let's learn about the governance. Now, if we look for the governance of the liquidity risk management, the first party that we always have is board of directors. It is related to board of directors. The overall responsibility will be lying with the board of directors over there. They will be deciding the strategy. They will be deciding the policies, procedures, audit process, and further the nature of the liquidity risk is particularly assumed, presumed, and managed by the board of directors. That's the first part, right? After that, the second tier, it's actually related to what? It's related to the risk management committee. Now, risk management committee is actually the board level subcommittee. It is a board level subcommittee and it reports to the board. It reports to the board, and further it is having the CEO. The RMC is having the CEO, that is the chief executive officer. They are having the CMD, that is the chairman and managing director, that is the CMD over there, and the heads of credit and head of market risk, head of the operational risk. They will be forming this particular committee. That is a risk management committee. Okay, and they will be evaluating the overall risks. They will be evaluating the overall risks, including the liquidity risk. Including the liquidity risk, that is a task with the RMC over there. Okay. The third tier is very much important. That is a ALCO. ALCO is actually what? Asset Liability Management Committee. ALCO is Asset Liability Management Committee. It also basically consists of the bank's top management, and it is actually responsible that the bank must be adhering to the risk tolerances. So whatsoever the risk tolerances, the risk limits, kindly please do pay attention. Whatsoever the risk tolerance, that you are not to basically go beyond this level, right? Risk tolerances or risk limits which are imposed by the board of directors, those are to be implemented. Those are to be implemented by the ALCO over there. The ALCO is to make sure that these guidelines are being followed in letter and spirit, right? That's the case. The fourth one, The fourth tier, the last tier in case of the governance structure of the liquidity risk management, it is the asset liability management support group. So we can say it is ALM support group. Now the ALM support group basically consists of the operating staff. Now what's of the operating staff that actually deals with the analyzing or monitoring or reporting to the particularly the profile to the ALCO. So basically ALM, if we talk about the ALM, it actually reports to the ALCO. It actually reports to the ALCO, and whatsoever the different things which are particularly reported, analyzed by the, that is a main task that lies with the ALM support group. Okay, and it also forecasts the simulation. So who forecasts the simulation? That what kind of liquidity or what amount of liquidity may be required by the bank so as to be maintained over the different time horizons. That forecast is actually given by the ALM support group. Is that clear? Is this particular part clear to you so far? Okay, so that is actually related to what? That is actually related to governance structure of the liquidity risk management. Okay, and after that it's related to the, particularly we are going to talk about the management of the liquidity risk. We are going to talk about the management of the liquidity risk. So let's learn about the same. So whensoever we are talking about management of any kind of risk, the first step ever included is actually related to what? It's actually the identification, because before taking any step we should be identifying, that's the first step, we should be identifying that these risks are actually present or not, right? And further we need to particularly identify and define that which particular line is exposed to what kind of risk and due to what kind of sources or resources over there, right? It may be due to the off balance sheet exposures, it may be due to the embedded options, it may be due to the contingencies exposures over there. So we must be evaluating that what kind of risk is there due to which kind of factors. And the second one, it's actually related to the measurement. The second one is actually related to the measurement of the particular risk over there, measurement of the liquidity risk over there. And there are two approaches for the same. One, it is related to the stock approach, and the other one, it's actually related to the flow approach. So for the measurement of the liquidity risk, we are having two approaches. One, it is a stock approach, and the other one, it is a flow approach, right? So we are having these two approaches with us. Okay. And further, stock approach is actually related to the first step that is to be taken. Okay. So if we talk about the stock approach over there, we can simply be saying that the stock approach is a first step that is to be taken, that we basically evaluate the liquidity risk. We basically evaluate the liquidity risk. So in this particular approach, if we talk about the stock approach over there, we basically calculate the different type of ratios. We basically calculate the different type of ratios, and these ratios are actually related to what? These ratios are LL, different ratios. I'm just writing the shorthand. I'll be explaining to you that how to memorize these, right? So we will be calculating the LL, and further we will be calculating the PA, LL, PA, and further we'll be calculating the CA, and further LD. So these four ratios are to be calculated. And what these four ratios are? LL means what? LL means liquid assets. It means liquid assets divided by the short-term total liabilities. Short-term total liabilities, right? So it is basically liquid assets divided by short-term liquid liabilities. And PA. PA is actually what? It is purchased funds. So whatsoever the funds that you have purchased funds divided by the total assets. Divided by the total assets. That's the second ratio that we need to calculate. These ratios are very much important. The third one is CA, not the chartered accountant. It's a core deposit to total assets. It's the core deposits to the total assets. And the fourth one, it's related to LD. LD is actually what? It is loan to deposit ratio. It is loan to deposit ratio. So in case of stock flow approach, we do calculate these four ratios. Okay, these ratios are calculated, and further these four ratios are actually compared to the benchmark. Okay, so what's the benchmark the bank has set as actually for itself, it will be compared with the same. That's actually related to the stock approach. Okay, so it is basically indicator of the past action. If we talk about the stock approach, it's an indicator. It's an indicator of the past action, right? That is the main thing. That's actually related to the stock approach. The next one, we are going to talk about the flow approach. It's actually related to the flow approach. Now, flow approach will be doing what? It will be forecasting. The main function of the flow approach is actually related to forecasting the different liquidity needs at particular different time horizons, right? Forecasting the liquidity needs. So whatsoever the liquidity the bank may be requiring at the different time horizons, that is particularly forecasted. That is, the forecast is given for that particular thing over there. That's actually the flow approach, right? And for the, it looks for the liquidity requirement. Like it may be the case that it basically looks for the requirement of the liquidity for today, that is for 1 day, and for tomorrow, that is t plus 1 day basis, and for the day after, and maybe let's say from 7 to 14 days, and so on, right? And this particular thing is said to be what, that we want to check the liquidity for 1 day, for let's say for 2 to 6 days, or for 7 to 14 days, or maybe 15 to 28 days, and so on, right? These are said to be what, this is said to be maturity ladder. This is actually said to be the maturity ladder, or we also name it one other thing, that is said to be what, it is said to be time buckets. So either we say it the maturity ladder, or we say it to be time bucket. What does it indicate? It basically indicate that the net cash inflow or outflow at that particular time period for particular 1 day, it's, let's say, it's actually related to what, let's say it says the time period, particularly inflow outflow is, net flow is 10k, right? It means there is surplus 10k that you are going to receive on the first day, and let's say for the 2 to 6 days it is minus 100k, that you need extra 100k liquidity with you as per the normal trends, right? That is actually the flow approach. That is actually the flow approach over there. So we basically talk about the maturity ladder and the time buckets, right? It basically helps us so as to maintain the particular liquidity over the particular time horizon over there. It just gives us an idea related to it. That's why we use the word forecasting. We use the word forecasting over here. Is that clear? Okay, so that is the main thing related to the flow approach, and particularly the stock approach over there. Now we'll be learning about the different, we will be learning about the different ratios over here. Different ratios over there related to liquidity. Different ratios related to liquidity that we are going to learn about. The first ratio that we are going to talk about, it's actually the volatile liabilities minus the temporary assets divided by the earning assets minus temporary assets, right? Now this ratio will be letting us know what, this ratio particularly let us know what, this ratio gives us the measure that up to what extent the volatile money supports banks basic earning assets over there. This is particularly indicated by this particular ratio. Now what do you mean by the volatile liabilities over there? If we talk about the volatile liabilities, what are these liabilities? So those deposits, those borrowings or bill payables which are having the maturity up to 1 year, those are said to be the volatile liabilities. Those are said to be the volatile liabilities. And also if we say that there is outstanding letter of credit, if we say we have borrowed the money from the Reserve Bank of India, or it will say it's a call money, or let's say it's a refinance facility taken by the bank over there, or it could be the current account deposit, or the saving account deposit, that is CASA over there. Those all come under the category of the volatile liabilities. Those are all are counted under the volatile liabilities over there. Is that clear? Okay, the second thing, the second factor we basically put over here in the numerator and as well as in the denominator, that's the temporary assets. Now temporary asset means, let's say the cash that you are having along with you, cash is a temporary asset. Today it is with you, it will be the case it's not with you. And further, it may be the excess CRR balance with the Reserve Bank of India. that you were to maintain the CRR at 4%, but you maintained at 6%, let's say. So whatsoever the excess CRR you were having, that's also a temporary asset. And balances that you're having with the bank, let's say case bank ABC is having the 10 crore FDR with the bank XYZ, right? That's also a temporary balance. That's a temporary asset over there. That's a temporary asset over there, right? So that's basically related to what? That's actually the temporary assets what are. Okay. So even if you have purchased a bill for a validity up to 1 year or discounted up to 1 year, that's also temporary assets. So whatsoever the different kind of assets that you're having, asset means the loans that you have sanctioned, but we are not talking about the loans. If we are talking about the deposits that the bank has basically deposited with the other institutions or with the Reserve Bank of India for up to the validity of 1 year, up to the validity of 1 year, those all are set to the temporary assets over there. The third component that we must be learning from this particular ratio is the earning asset. That what are the earning assets? So if we basically subtract the fixed assets balances in the current account with the other banks over there, other assets which are excluding the leasing over there or intangible assets. So if we subtract from the total assets the fixed assets plus intangible assets plus deposits with other banks, deposits with other banks in broad, right? That will give us what? That will be giving us the earning assets. That the assets which are basically put on earning, right? The bank which has invested the money. So that is our only earning asset now. So we won't be saying, because we cannot be calculating each and every loan. So we'll be taking the total assets and we'll be subtracting the fixed assets, intangible assets, as well as the deposits with the bank over there. And that would be related to giving you what? That will be giving you earning assets over there. Is that clear? That was the first ratio. The second ratio, and further, if we talk about this particular ratio, as I told you, it will be letting us know that volatile money supports banks earning assets. How much? That is the extent. And further, there is particularly, it is implying what? If you are having a high number of the same, if you are having a high number of this ratio, if this ratio is high, it will be good or bad? Kindly do answer at the earliest. I've told you the different particular things over here, why these assets particular ratios come important. I'm not talking that this is going to come directly as in the form of the particular numerical over there, but it is very much important for us to understand these particular ratios because it may come in the exam kahin se bhi. Okay, so it won't be basically coming in the direct manner over there, right? They will be asking the question independently, right? From this particular topic it can be asked, right? So this asset should be high, this ratio should be higher or wrong. So if a high and positive number is there, it will be implying risk of illiquidity. It will be implying some risk of illiquidity, that the illiquidity may be there, that the illiquidity may be there. Now let's move to the second ratio. Now let's move to the second ratio, and it's actually very easier one. It's a core deposits. It's a core deposits divided by the total assets. So we're talking about the core deposits divided by the total assets. That is the second ratio we are going to talk about. Okay. So in the first type, the industry average of 40% is to be maintained. That was the benchmark. And the second type, the industry average is 50%. That is a benchmark. It basically showcases what? It showcases extent to which the assets are funded through the stable and deposit base over there. So core deposit means what? What do you mean by the core deposits? The core deposit means we are talking about the CASA. That is the current account saving account balance. We are talking about the CASA, which is actually CASA above 1 year. Up to 1 year part of the CASA is considered to be what? It is considered to be the volatile part over there. It is considered to be volatile part over there. So above 1 year, we say what? Above 1 year, whatsoever the current account saving account deposit it will be having, that is a core deposit of the bank. Right? Plus net worth. Plus whatsoever the net worth the particular bank is having, that is also the core deposit is, right? So the sum of two things makes the core deposit, right? Is that clear? Now let's learn about the third ratio. Let's learn about the third ratio, that is actually loans plus SLR, that is statutory liquidity ratio, plus CRR plus fixed assets divided by the total assets. Now this is actually indicating what? If we just look at the numerator is basically showing us the least liquid type of the things or least liquid type of the assets. So the numerator over here, if we talk about this particular numerator, It is indicating the least liquid things. Okay. So if this ratio is higher, it will be showcasing there is higher degree of illiquidity. So if this is higher, means higher illiquidity, means higher illiquidity, right? Is this particular point clear to you now? Okay. After that, the another ratio we are going to talk about, it's a numerator would be all same. That is a loans plus SLR plus CRR plus fixed assets divided by the core deposits. Now the above ratio was higher, it would be riskier. Above ratio, this was higher, it was riskier. But the particular, this one, numerator is a particularly riskier one. And further, if we basically talk about the, it will be letting us know what? It will be letting us that the extent to which the illiquid assets are financed out of the core deposits. Okay. So how many core deposits were particularly used in a way so as to create the illiquid assets? And the industry average for this is 150%. The industry average is 150% over here. Is that clear? Kindly do confirm. Okay. The next ratio we are going to talk about is the temporary assets divided by the fixed assets. Temporary assets divided by the fixed assets over there. It basically says extent of available liquid assets with you. Higher ratio means what? Higher ratio means that the asset utilization opportunity cost of holding the liquidity with you. That why you are basically if this ratio is higher, it means you are not able to manage the liquidity with you. If this ratio is quite higher, it means you're not able to manage the liquidity with you. You are basically losing the opportunity cost, that you have not invested the money somewhere where you'll be making the money out of it, right? So that is the scenario. So that will be the scenario with it. Okay. Now after that, I've already explained the different types with you, and now we are going to cover the stress testing. We are going to cover the stress testing. Now, what do you mean by stress testing? Now, we basically look for the normal type, like I told you about the different approaches. We basically learned about the stock approach or flow approach over there, right? But the point over here is that is actually under the normal conditions. What about the abnormal conditions? Now, if there be abnormal conditions, definitely it may be the case that you basically may require more liquidity. So we should also be considering the extreme conditions where the bank may be requiring the more liquidity over there. And further, the results of the stress test which are basically there, those must be considered in detail by the asset liability management committee, that is the ALCO over there. And remedial and further mitigating actions must be taken in such a manner that the whatsoever the stress test results are, those are basically identified. That is the main case related to the stress testing over there, right? And further, we are also having CFP. Now what is CFP? What is CFP? CFP is contingency funding plan. It is contingency funding plan. Now what is indicated by the contingency funding plan? Now, it may be the case that there is a serious disruption in the system or serious disruption by the economy itself. Now, it will be basically be helping the banks so as to manage the very severe liquidity stress conditions over there. It may be bank specific or it may also be the market specific. Bank specific when only bunch of bank or single bank is not able to maintain the liquidity with them, and market specific when the whole market is down and further no one can do anything about the same, right? So in that scenario, CFP will be helping it. And it actually, the planning depends upon the complexity of the bank itself, that how complex the bank profile is, how risk profile of the bank is. So those facts will be considered, right? That's the main thing related to it. That's the main thing actually related to it. Okay. Now the bank is having, let's say bank ABC is over here. Bank ABC is over here, and it may be the case that the Indian bank's branches are outside India. Let's say it's basically a bank branch in India and these are the branches over here in USA. So in the case that the bank is having the branch over here in USA, All right. It may also the case that the bank is having some subsidiary over here. It may be having some subsidiary over here. And also it may be the case that a foreign bank is having a branch in India, is having a branch in India. Now, in those all the cases, what are the liquidity guidelines which are to be taken care of? Which are to be taken care of. Now, for that particular cases, there is limit on maturity mismatch. There is limit on maturity mismatch. Now, what do you mean by limit on maturity mismatch? Like, let's say consider the case. Let's just consider the case over the time horizon of 1 to 3 years. 1 to 3 years, the maturing assets are, let's say, 400k, and the maturing liabilities are 100k over there. Maturing assets are 400k and maturing liabilities are 100k. That's a positive gap or negative gap. Maturing assets means that you are going to receive money, and maturing liability means that you are to pay money. That is cash inflow and cash outflow. That's the scenario. That is the scenario. And when it is a case of the cash outflow is more than the cash inflow is more than cash outflow, there is a positive gap. It's all same or all simple, no issues in that. But what if there is a negative gap? Let's say there is a negative gap of 600k. Like, we were having the maturing liabilities, that's the amount that we were going to pay. The amount that we are going to pay is basically 700k, and the maturing assets that you were having is 100k. Now the maturing, you are having the gap of 600k, and that's a negative gap, right? Now in that particular scenario, it is particularly said that for those all the cases where we're talking about the branches of the Indian bank in the foreign country, or subsidiary of the Indian bank in the foreign country, or particularly foreign bank branches in India, right? For those all the cases, the long term resources, we are talking about the long term resources, those long-term resources should not be falling below the 70% of the long-term assets. So the long-term resources, resource means the deposits, right, should not be falling below the 70% of the long-term assets. So these should be greater than or equal to the 70% of long-term assets. That's the first case. So that is the first case over there. The second one, it says the long and medium term resources. So we are now talking about the long as well as medium term resources, means liabilities particularly should not be falling below the 80%, should not be falling below the 80% of the long term assets, long term, medium term assets plus long term assets. Is that clear? Is this particular part clear over here? That is the main funda. And also these controls, these both the controls, first control and second control, both are to be maintained currency wise. These are to be maintained currency wise. It, let's say we are dealing with a different country, with one country we are dealing in the Australian dollar, with the other one we are dealing with the GBP or particularly euro over there. Now for both the currencies, these two things are to be maintained differently. These two things are to be maintained differently, where the individual constitution currency in our balance sheet is more than 10%. Like, our total balance sheet is amounting to rupees 1000 crores, and further we are dealing in USD, and for the amount of the USD that we are dealing with is particularly, let's say, is 20 crore, then definitely these two things are to maintain for the USD over there, right? So that's the scenario. So that is the scenario that we should be taking care of, right? And for the netting of intercurrency positions and maturity gap is also not allowed. It's not the case that you're going to, over a time horizon, you're going to receive USD and Canadian dollar. You should not be intermixing the same. That is actually not allowed over there. That is not allowed over there. And when we're talking about the short term, we are talking about up to a period of 6 months. When you're talking about the medium term, we are talking about a period from 3 to particularly, let's say, 6 months to 3 years. And we are talking about the, if we are talking about the long term, it means we are talking about for a period for 3 years or longer than 3 years, 3 years over there, right? So that's the scenario. Okay, so when we're talking about the short term, it's up to 6 months, 6 months tak ka, right? If we're talking about the medium term, it's basically 6 months to 3 years, and further we're talking long term, 3 years or more than 3 years, right? That's the case. That is the scenario over there. Okay, No, it's actually related to the reporting to the Reserve Bank of India. Very important topic, and we'll be covering it at the earliest. And tomorrow we are going to cover the case study for the same structural liquidity ratio basis case study that we are going to cover the same, right? And further, there was one case study which was being asked by a student that we were not able to basically complete related to Basel 3. We will be covering that particular case study tomorrow also, because today it was very lesser time and I was to complete module B. Sorry guy for the same. I basically promised you that I'll be completing it by today itself, but due to that particular time constraint, I was not able to do so. So I'll be covering it tomorrow video for sure, right? It's actually related to Basel 3, and for that it's based upon the proportions calculations, right? So no worries for the same. Now let's basically talk about the statement of structural liquidity. It's actually the STT, structural liquidity statement, that is to be submitted to the Reserve Bank of India. It is statement of structural liquidity. Now, when we're talking about the statement of structural liquidity, there are actually five things or five form of reports which is to be reported to Reserve Bank of India, right? And it is basically based upon the different buckets like we talked about. So it's actually based upon the bucket of the next day, right? There are how many buckets? 11 buckets, right? So next it's actually 2 to 7 days. Further it's 8 to 14 days. Further it is 15 to 30 days. And then it's 31 days to 2 months, to 2 month. And further greater than 2 months to 3 month. And the next it's actually greater than 3 months to 6 months. And 6 months greater to 6 months to 1 year. And further 1 year to 3 year, greater than 1 year to 3 year, and further greater than 3 year to 5 year, and greater than 5 year. These are actually the different buckets we can say. These are the different buckets: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So there are 11 buckets. There are 11 buckets. Next day, and further 2 to 7 day, 8 to 14 day, 15 to 30, 31 to 2 months, 2 months to 3 months, 3 to 6, 6 to 1, 1 to 3, 3 to 5, and further greater than 5 years. Okay, so these are the different buckets. And the statement for the same is to be done. And there are five parts of the reporting that is to be done to the Reserve Bank of India. Let's have a look at it at the earliest. First of all, we are talking about the statement which is to be submitted fortnightly, which is to be submitted fortnightly, right? Basically, let's say on every 15th day, the statement is to be done, right? That is the first case. It's for the domestic currency. When you are dealing with the domestic currency over there in Indian rupee, right? And further, it's actually about the Indian operations. Whatsoever the business is being done in India only. For that particular case, reporting is to be done fortnightly. The second scenario, for foreign currency, we are talking about, now we are dealing in the foreign currency, but for Indian operations. Foreign currency, but for Indian operations. That is also to be reported fortnightly basis. And further, the third one, the combined statement, combined Indian operations, combined statement, we can say Indian operation statement, right? So that is also to be done on fortnightly basis. Now the fourth one and the fifth one, the reporting is to be done on monthly and quarterly basis. Monthly plus quarterly basis reporting is to be done, right? The first one is actually related to for overseas operations, for overseas operations. In that scenario, the reporting is to be done on monthly and quarterly basis. And also consolidated bank operations, the complete report, whether it's basically inland or outland, right? So all the operations are to be covered. That is also to be done on monthly and quarterly basis. Is that clear? Is that particular part clear over there? Okay, so reporting date for fortnightly basis, it will be 15th and last day of the month. And further, if the 15th, if the 15th or last day of the month are holiday, then the report is to be done on previous day, previous working day. The report is to be done. Is that clear? Okay, and when we're talking about the month end and quarter end, that is actually on the last of the month or the last of the quarter, the reporting is to be done. Okay, so that is actually all about the reporting standards. Those are to be maintained, and that was actually all about the particular module B. But in tomorrow's session, we are going to cover the case studies. Okay, so that is going to be very much important. Session number 9 is going to be very much important, and then we'll be starting with the module C over there. That's actually to do treasury risk management. And I hope that you must have enjoyed the session over here. So if you have liked the video, kindly please give this video a thumbs up and do share it with your friends and colleagues. And further, if you want to win a free Maha combo pack of the CAIIB, simply WhatsApp us writing the CAIIB group. And further, you can also be getting a chance as to win the free Maha combo pack for CAIIB for 3 months validity. So that will be all. Thank you so much and see you again in the next video tomorrow. And yes, also the next session is going to be ABM today. Today itself, like at 10:30, we'll be starting the ABM session, that is Advanced Bank Management, and we are covering the module A for now, and definitely it's going to help you a lot. So see you soon in the next video.